All right, we're heading into the bell here with Stocks A Little Change. Joining me for a big picture discussion, Mr. Jeff Kleintop and Mr. Collin Martin. Jeff's Chief Global Investment Strategist and Collin's a Director and Fixed Income Strategist. Collin, how come bonds are selling off today? Because we got nothing going on in stocks, and it seemed like this morning our data came in light, but we're getting a decent little pop in Treasury yields.
Yeah, there's a few things we could look at. The first was late. Well, the second, I guess we can touch on briefly is a somewhat weak 5-year auction. But even talking about that wouldn't really explain the move. It came in a little bit weak, but nothing to write home about. It could have to do with the decline in the yen. There's thought that Japan might need to intervene, or maybe is currently intervening, and how they would do that would be selling some treasuries to kind of manage their currency. Japan's the largest holder of U.S. treasuries. They hold over $1 trillion worth of U.S. treasuries. So there's some thought out there that they could be selling treasuries to intervene a little bit. But as you alluded to, that's really all we're looking at. The economic picture was a little bit lighter than expected, but really since the last FOMC meeting 2 weeks ago, we've been in a tight range, and it looks like, for the most part, markets are really just waiting to Friday's PCE report to really see what that inflation outlook has looked like compared to where we were 2 weeks ago when we got that relatively soft CPI number.
Got it. Looking for the inflation, I guess, and prints the next 2 days to bring us some action here. To your point about Japan, though, Jeff, curious to get you to weigh in on that. What does it make sense for the Japanese to start dumping treasuries, or is that kind of the rumor we heard for China for a long time too?
Well, I think some QT is on the table for Japan. So the yen did hit a low for the first time in probably 4 decades. Hitting a new 4-decade low after Japan's currency chief wrapped up his comments, and that underscores the fact that words just aren't enough, and the markets are demanding actions to stabilize the yen. So there's some potential intervention in the coming days to support the yen, but the market's pricing in a 52% likelihood of a rate hike at the next meeting by the Bank of Japan in July, in addition to the potential unveiling of a roadmap for quantitative tightening, finally beginning to pull back from all this bond buying. And that could begin to turn around the direction of the yen. But those potential actions are still a month away, and the path of least resistance for the yen remains to the downside.
Okay. So it does seem like, we're maybe starting to see a little effects, because as a guy who likes to look for daily and intraday causality, there's not much else than this Bank of Japan story to explain what's going on in bonds. So I'm kind of with it there. So let's talk inflation in the data next 2 days here, Colin. Durable goods, GDP, PCE. Might we get another really cool number like we saw in the last reading for CPI?
We're hoping for a cool number. Our outlook hasn't really changed. We know that inflation's a little bit stickier than we expected it to be, but we do think the downward trend should resume. We got really good news with both the CPI and the PPI report a couple weeks ago, and that all feeds into the PCE report. So I think the markets have a generally good idea of what we'll get on Friday. What's kind of funny is how it really comes down to rounding errors now, or just rounding in general, not necessarily errors, where the difference of a 0.14 or 0.15 can spook the markets. If it's 0.15, we're going to round up to 0.2%. If it's 0.14, we get to 0.1%, just in terms of a headline, what we see as investors. So rounding can play a role there. But we do think the disinflationary trend should continue. A lot of that stems from the labor market. We're starting to see it come into more balance, not necessarily big cracks yet, but just more into balance, with an unemployment rate at 4%, initial jobless claims rising for 2 consecutive weeks. Things like that should at least slow spending enough that inflation can continue to moderate. So our view hasn't really changed much, and we do expect that disinflationary trend to continue.
Okay, well, when you got the month-over-month expected to come in at 0, then nice, cool print would give us a negative, and I'm sure markets would love to see a negative out there again. Jeff, keeping us honest on world events, give me the latest on the election situation, the drama in France, and I don't know, I might be missing somewhere else as far as the politics go.
Well, tomorrow Biden and Trump hold their first U.S. presidential debate, and that could move things around given their controversial topics over tariffs and globalization and the Fed and the dollar and everything else. But last night, we got the debate between the leaders of France's 3 main political parties, and bonds in France sold off. They widened about 2 basis points in their spreads to Germany, and stocks sold off about 0.7% in France. That was pretty much the biggest move I saw anywhere around the world. Now, Bardella, who's under 30, by the way, and is the head of the National Rally, which is the party leading in the polls, said he would lower the retirement age in France back to 62 from 64. That is a costly vow. And he also said he wouldn't raise taxes. So the market's fearing a wider budget deficit for France as a result of these plans. But markets might be comforted in the weeks ahead as the votes take place that most pollsters right now are predicting the National Rally will win the most seats, but fall short of the 289 needed for an absolute majority in France's legislature. The point being, gridlock could be the outcome. So any ambitious legislation that could really widen the deficit may be difficult to pass, and that could mean a sigh of relief for markets, particularly those in France that have sold out of 8% in the last week or so, that are worried about major deficit widening. That is a similar thing that happened in the UK when they quickly backed away from their spending plans back in 2022. And if they did recover, well, France stocks maybe could rebound 8% in the coming weeks. So we'll be watching that very carefully. That first round of voting is on Sunday.
All right, sounds like it's introducing a little bit of uncertainty into that pretty persistent, pretty reliable international equity trade. And a good reminder, too, we got our own little spat tomorrow night. All right, thanks, guys. Appreciate it. Collin Martin, Jeff Kleintop.